So today is a webinar that we are co-organizing with the Fix Civil Society Coalition. This coalition from Finance in Common is an ongoing initiative linking public development banks and civil society organizations to formalize a dialogue and improve development finance accountability. Sandra Martinsone has been a long friend of the agri-PDB platform and has been challenging us, and it has been a pleasure on this specific topic, how to imply more civil society in our debate. And today, this webinar has been organized because Bond has been publishing a study in May, I think, that is suggesting that development finance institutions should channel more capital towards locally owned businesses and in linking it with country-led priorities rather than relying on offshore intermediaries and externally driven models. For agricultural finance, this means investing more in food system, resilience, and domestic value chain. That's where national public development banks from the network of the agri-PDB platform have an important role to play here, and I hope that this webinar will be an interesting debate. So after Sandra Martinsone from Bond, we will hear also François Babazi, who is the Chief Executive Officer in Ingabo Farmer Syndicate in Rwanda, and Mankoba Mazibuko, who is the Manager Business Development Support at Eswatini Development Finance Corporation, FinCorp. So thanks a lot. And before we start, Anaïs, maybe you have some
Yes, thank you very
technical
much.
elements to
Yes,
share.
thank you very much, Thierry. Thank you all for joining. Just before going a bit deeper into the subject, I just wanted to remind you that the webinar is recorded and will be available afterwards on our YouTube channel and our website, which I will share then on the chat. Also, towards the end of this event, we will have a question and answer session. So we encourage you to think about any question you may have to our panelists and write them down using the chat option at the bottom of your screen. And of course, we will try to assess, kind of read all the questions and respond to all of them, but we will try to give priority to the questions asked by the public development banks. And thank you all. And now, as you may have read on our invitation, this webinar as per basis the report named Locally Led Development and Development Finance Institutions, the case of British International Investment, which has been produced by Mrs. Sandra Martinsone. She's the trusted deputy chairwoman of the board of the Latvian Platform for Development Cooperation. And we are very happy to have her with us today. And I leave you the floor now. Over to you, Sandra.
Thank you so much for having me here. Really appreciate this dialogue we have been having over the last months or even a year. And really, as well, I think I will also compliment agri-PDBs coalition and Fix in general for really doubling down on the engagement with civil society, the dialogue, and I hope that even if it may come as a challenge, we are friends, and I think we work towards the same purpose. So I think I really appreciate this dialogue and engagement. Maybe just a little bit of a background whilst I get my PowerPoint up, sharing. I just wanted to just to recap and say as well. So this report was published in April, I think. And really, for the context, really the purpose was that we heard more and more from the UK government, but not only the commitment for shifting the power for more locally led development. And as you maybe you know, in May as well, UK government did a global partnerships conference where this was one of the core themes. And from the civil society side, I think we were thinking, okay, we need to expand this understanding and interpretation of this locally led development agenda as one, not being only as something what civil society or international NGOs need to do, but it's also about the other kind of development, international development actors, including development finance institutions. And as you know, being based in the UK, so we focused in this research very much on the BII. But in my presentation today, I will actually not talk that much about BII. I'll try to be a bit more general and talk more about kind of the trends and how potentially this journey, you know, for doing things better, meaning more with a kind of locally led development agenda, what does it mean, you know, for public development banks, which includes both DFIs, but also national development banks and you know, also the multilateral development banks or regional. So that's really, yeah. And also,
could you move in full screen, please?
Yes, sure. Let me just.
It's just on the bottom of your screen. Yeah, perfect.
Yeah. Okay. So so why locally led development? So essentially, what we also you know, what generally the literature is talking about, but I think also that the evolving narrative about shift towards a more locally led development, at least as a narrative and as a commitment that, you know, without full kind of understanding of local context and working with the kind of more kind of local ownership, you know, many development initiatives, you know, would fail and essentially obstruct actually the long-term economic transformation. You know, development which is not owned and led by local agencies, so meaning the local actors, but kind of comes more kind of from outside, you know, can't be really sustainable, because in a way it's kind of the development, that action is kind of done to the locals rather than done by the locals. And in a way it's also a precondition for this kind of long-term economic resilience and also transitioning away from order dependence in the long term. We think that you know, whilst order obviously is needed, and we all in a civil society, it is still something what we really need to advocate for. At the same time, you also need to think how we actually make the countries less dependent on order. They can really kind of graduate, you know, from the sort of the order receiving countries, then they can lead their own development. And you know, more broadly, it's also sustainable economic transformation. So I'm not talking necessarily about the growth, but transformation requires this quality, inclusive growth, economic autonomy, economic justice. And those are kind of very much then in line with the locally led development principles. And that's the vehicle, you know, to get there. So really the key objectives of localization, I'm saying this so that we kind of have that shared understanding of what we actually really talk about locally led here. And I think it's worth spending time on that. So obviously, first of all, it is really more kind of normative, right? Like about that we, you know, that the priorities and needs and solutions, problems and solutions are defined locally. So again, you know, there's that embeddedness in local context, and those are not so that the solutions imposed from outside. And again, it's not necessarily undermining anyone, you know, and I can talk about myself or even the UK kind of civil society sector, what we have been, I've been part of, and or more in generally international, you know, also civil society community. So it is also in a way quite introspective and also maybe self-critical point as well. But we need to kind of understand that, you know, we have to put the kind of the locals really at the center of also establishing these solutions, which isn't always the case. Then it's also instrumental. It's really as well, there's that kind of thinking that, you know, there's locally led and owned. That is what is really ensuring us that we kind of can deliver improved long-term effectiveness, sustainability, and really driving the transformative change. And again, it's the you know, when initiatives and solutions are owned more by the locals, and also you can expect it really in long term that self-sufficiency and the kind of development rising. There's also this emancipatory role, again rebalancing the power and building a kind of higher self-sufficiency. And again, you know, so again, not to say that external actors don't have the role, of course. So that's not about what to say that, but how those relationships are delivered. It's really important, and that's again where we kind of give more say and a space for the local actors. There's also, especially if you look at from the global north perspective, there's this kind of moral argument as well, that there have been lots of kind of historic injustices done, either through the colonialism and generally exploitative economic relations. So again, this more locally led development is to kind of to repair these relations. And last but not least is obviously there's also this political, especially if you, for example, talk about the African continent, many would say that this kind of the political independence was gained, but not necessarily the economic independence, and still through the kind of economic system, those relationships have kind of remained kind of dependent on the kind of either global north setup or the kind of the support. So again, for that reason as well, so democratizing the system and relationships is critical as well to just move forward. So who is the local? It's like, okay, engaging locals. So who is the local? So this is as well an effort to translate that for PDBs. Some apply maybe more for let's say national, some for let's say DFIs, MDBs. But we really talk about micro and small medium enterprises. We do talk also about some larger, companies as well, but they have to be more kind of strategically and systemically important, enterprises. And we here we may talk about some really strategic sectors, maybe like energy, transport, water, some of the really critical infrastructure kind of critical sectors, which are really important for the country's development. We talk about informal sector, and especially in Africa's context, this is a really big share of community people operating in this sector. Communities affected by the investment project directly or indirectly. Local indigenous knowledge collectors, creators, amplifiers, trade unions, chambers of commerce, local governments, various, and especially including also, not the kind of by the Western standards, the kind of government actors, but the other kind of more cultural and culturally appropriate kind of also the structures, and women and young people especially, as we know, they are critical as well, but two particular groups, and also all the kind of underserved, excluded, and marginalized groups, especially when we talk about PDBs serving the kind of the most in need. So we need to really unpack as well. So who are the people kind of most in need, and that's kind of speaks to that. So key dimensions of localization. So essentially we can talk really about three kind of categories. Agency. So one is really about ability of local national actors to identify their own problems and solutions. And the second one is about resources. So what kind of resources are going to who, on what terms, to do what. And the third one is ways of being, so kind of more respecting the kind of cultural identity, values, ways of working, and so forth. For this report, I mentioned here, but I also make a caveat. So going forward, the third dimension, we are not looking into the report, because it requires way more kind of data which we couldn't access and is not available. So that wouldn't really give us a kind of meaningful information there. So therefore, in this I will focus mostly on the agency and resources. So now going first about the agency. So as I said, so agency is really about local national actors to identify, to be part of the both kind of defining what are the problems and also what are the solutions, and they are also co-owning that. And again, the reason why it's important, so that is that ownership of the development pathway. So again, that it's not that the actions are done to the people, but we are more likely to succeed in a long term if we do with the people together, you know, and obviously also for, but not just at them, you know, just like here it is, and making them in a kind of a just a receiving way, and not necessarily being kind of subjects, right? So like we do something for them. So the questions we can ask here from the PDBs side, and I'm being mindful as well that some of these maybe are applying more to the DFIs than maybe national development banks, but I think it gives a broad enough that framing. So is there a space, time, opportunity provided to engage local actors and in an inclusive engagement and dialogue with so that stakeholders engaged by the PDB, and especially the ones who we claim to really try to support, right? Like often we talk about the most in need, we often talk about women, young people, small SMEs. So where are those voices? You know, farmers. You know, are they actually involved in the you know, a process of the kind of both defining what are the problems and also what are the solutions? Are they involved in decision making? You know, so how is the investment committees or boards composed? You know, who is on them? You know, who is represented there with what kind of expertise, knowledge, background? Are the produced goods and services supporting the communities and the kind of local markets, or it's very much kind of how we, you know, try to, you know, think about the exports and just kind of what the rest of the world needs? And are they produce goods and services concessional financially and physically? So how, in what, you know, so that access to these goods, and how are, you know, PDBs or DFIs really demonstrating that accountability to communities, right? We write all sorts of reports, and but, you know, in a more practical way, you know, how we hold that accountability, how we build that accountability, that making sure that actually people who we say we serve, there's also that active kind of dialogue, active engagement, and active in a way of checking, you know, if what PDB is doing it's on the right path, and there's that support, broader kind of support from those communities. When it comes to resources, so this is really about the quantity, quality, and accessibility of the funding, you know, transferred to these to those who need the most, because again, we talk about public development banks, so therefore this is public finance, and again I think the premise here and the base is really as well that the public finance has a unique role compared to private finance, and therefore, you know, we have to prioritize those who are most in need. So the questions here are about, are investments going as well to the locally owned and managed companies? How big you know, share is going to the intermediaries? And again, if the intermediaries are involved, so again, are these local or these international? And how they again, you know, how they make decisions, how they are operating within that local context. And, you know, the very basic question, are these funds ultimately going to those most in need? You know, so it's a kind of alignment, you know, with the public finance, kind of the really original purpose. How accessible or burdensome is the funding? You know, like, are the administrative legally, is it actually easy to access this funding, or actually, you know, it's once you meet this kind of the requirements, and actually a lot of the kind of target audience becomes excluded. And you know, to what extent as well these financial transactions are from the kind of the donor's self-interest, and that particularly here meaning actually especially the international DFIs, so the ones you know, from the global north, then working in a global south, low middle income countries, and how their strategies and investment decisions, you know, how free or not free they are from, you know, other kind of sort of geopolitical interests. So when it comes to then report findings, like I said, report was done analyzing the BII data. So some of these, well, obviously these insights are coming from the BII, but in this part, I'm trying to make this kind of more general, and I'm not making any specific references to the BII's actual, investments or all kind of statistics. But generally, I think there's and broadly having looked as well at some other DFIs, I think these are kind of the trends which BII is not the kind of outlier. It's a quite a sort of trend overall in amongst the DFIs. So so the first one challenge within the agency agenda. So it is about identifying local challenges and solutions. And what we are finding, I think, across the board is that broader stakeholder engagement, especially with the community, so civil society, is quite ad hoc. It's definitely it's not systematic, and it's not something kind of standard. We find very few kind of examples. Existing ones, and for example, Force has done a kind of deeper study on that one amongst some of the regional and MDBs on this topic. But there's definitely room for improvement. There's intentional alignment with national development strategies, SDGs, climate actions, NDCs, and all of that. But it's not necessarily. Well, it is a question, right? So, to what degree that alignment is also built into the investment decision-making process, right? So, when the companies, investees are proposing certain activities, or when there's specific investment proposals are discussed. That precondition is not necessarily always there, that it has to fit somewhere in a country's some kind of national development strategy. And I think that is that missing part. It might be work sort of by accident, but it may not necessarily be like a requirement. And even with SDGs as well, I mean, SDGs is obviously there are 17 goals, and often what we see is that investments would say, okay, this project is supporting SDG 7 and 9, or 4 and 6 and something, but it doesn't mean that for example, it doesn't undermine SDG 2, for example, right? So the holistic kind of approach as well, like the investment projects which are not just cherry picking, certain things and kind of ticking the box and saying, okay, this is contributing to, let's say, economic growth, but then if economic growth is actually maybe undermining food security goal, then it's a question, right? Like how well designed that intervention is. And then is also, especially with the international DFIs and PDBs, this is also the question about the local and foreign staff. So what kind of expertise you have, a presence in the partner countries, and so again, what kind of information you use to make decisions, and where is your kind of local expertise coming, if at all, how big is that? The next one is about the making decisions, and again, it's quite HQ dominated. So a lot of the decisions are made in where the headquarters are of the DFI. Relatively weak representation of those who we aim to support, or is that kind of the background and kind of lived experience and deeper kind of understanding of either the gender inclusion issues or smallholder farmers or generally kind of the regenerative, let's say, farming practice, or what does it mean, for example, as well, like a inclusive infrastructure, or so on and so forth. Also, the kind of really is very much about the market-driven kind of deal sourcing. So that's looking at bankability and obviously commercial viability versus the kind of the need. What are the highest needs? And sometimes maybe as well considering, again, this is a public finance, so where maybe some concessionality actually would be desirable to achieve the kind of goals what we have. And sometimes the bankability is really limiting, what kind of an investment projects, where the kind of the finance is actually going, right? There's a requirement for that bankability. Then meeting the local needs, and here is again we are trying, I guess challenging a little bit to think beyond just creating jobs and creating opportunities for income. because it's also about, is the actually produced goods and services, meeting the needs of the local people, of local economies, like who we are kind of serving, what is that economic activity, who we are serving. And I think that's often is as well about which can reinforce actually some of these projects as well, the kind of extraction, when we use the available workforce, right, and other kind of resources what are available in a country, but maybe for actually consumer needs outside the country. And then it's a question, like is that the model, how we lift these people out of poverty? Does it actually really work? And that's also is a question further about the self-sufficiency versus dependence. So what kind of economic activities, what kind of investments we make, and thinking as well from is that creating and strengthening the self-sufficiency, so that the country is really resilient, and especially nowadays when we look at what's happening globally, both kind of climate agenda but also geopolitics, there's a high price for being very dependent on let's say global supply chains and global markets, and that dependency, right, on even some basic goods, especially when it comes to food sector as well, when lots of countries are really dependent on that, on import food, for example, that becomes almost like a national security issue. And then obviously also the question about relatively small share kind of going actually to low and middle income countries and fragile countries. So in this case I'll mention, so in the BII's case it was probably around a fifth of investments have been going there. So again, it probably could be more, considering again the role of DFIs, and we think it should be going more to the places, the really hard places than it's doing it now. And then also the local access to produced goods and services. So this is again as well, are the kind of produced goods services, they are actually accessible to general public, or they are kind of upper middle class sort of consumer targeting, and then again is a question of what's our really theory change of how we are supporting through this people who are at the lowest levels of income, and not making these kind of investments, then serving the kind of more the upper middle class people, or only export kind of consumers living somewhere abroad or in the global north. When it comes to resources, so here the issue was about the local ownership, and I think I can talk a bit more maybe if there are more kind of questions on this. But the local ownership is quite critical here as well, because it's not only about where the money is going, and to do what, but also really who owns it, because that ownership also will define, like if that money is, how likely it is that the money is then, the profits, for example, are reinvested in the same society, the economy, right? Or they are extracted essentially, and profits taken where the sort of the, overall the owner is. Ownership also means, that that's a tax issue as well, because what we also found that a lot of the investments go through the offshore domiciled companies, also through the UK and G7 based businesses. So that also has for sure, but it's hard to provide a very rigid kind of data, but maybe that's something as a challenge for some research institute, really, a research organization. What is the real quantitative impact of this? But there's clearly impact on also the kind of the tax income in the, especially in lower income countries, when a lot of the businesses are actually then not fully based and domiciled in those countries. Focusing on those most in need. So again, a lot of the investments go to support large corporations. We found also there were, also some billionaire-owned businesses. So I mentioned already, only about a fifth goes to low middle income countries, fragile conflict affected countries. Informal sector is also reached only indirectly, and some DFIs, for example, or probably PDBs don't necessarily work directly with informal economy or informal businesses. So, but that means you exclude huge part of the society, and we know also in many countries, actually most of the large parts of the SMEs, micro SMEs, are actually within the informal sector. So again, a large part of who actually would need the support are actually not really covered by these instruments. They can be used through the intermediaries, so either the kind of banks, local banks who then on lend, but then also there's an issue around less oversight of what exactly where exactly that money is going to do what for who and what terms, and that's as well is where a little bit that accountability issue is coming more prominent, and again I'll mention here as well that yes, as I mentioned before, that some of the products maybe I feel like are kind of for upper class kind of people, higher income people. Then also we see still that there's investments, which like in luxurious hotels or fossil fuel, which do not necessarily align with what we would see in SDGs or just generally what is the public development bank's kind of agenda, where really the investment needs are. And some of this stuff really has to be left to the private sector to address. And then last in this section is the access to funding. So sometimes as well, when we see that high investment thresholds, so like the expectation that you deal only with 10 million or so kind of projects. So that's limits with who you can engage, and then also really high cost of capital. So again, really high rates what we can offer to the businesses. That means that there's locally embedded these businesses, especially smaller ones, and in an informal economy, so they really actually struggle to access that development finance. So that is a question, like, do we have the right instruments to support those who have the highest needs? Way forward.
Sandra, sorry,
yeah.
I think we're just going a bit over time. Do you think you can maybe wrap up in 1-2 minutes?
Yes, sure.
Sorry,
I'll try.
sorry.
Yeah, very quick. Yeah,
Thank
that's
you so
fine.
much.
So way forward. So yeah, half a minute hopefully on this one. So way forward on agency. So very much what we are saying here is about creating kind of more standardized, formal, regular engagement with local stakeholders, at country level and sector investment strategies. So it's really there's that buy-in, and there's a kind of as well broader support, from onset, not when you don't engage only when things go wrong, but you engage from the very beginning when you think about, okay, where are we gonna invest, what would be useful. I'm also making a recommendation for this PDB CSO coalition as well to work on that kind of more collective kind of guide, on how DFIs can advance, PDBs can advance locally led development. I think that would be really, really useful tool, practical tool going forward. Then also reviewing the membership and representation of the decision-making bodies, again, what kind of people we have in a room to make decisions about investments. Supporting more local and regional supply chains, so that really advancing that economic resilience, self-sufficiency in a critical strategic sectors, and really explicitly targeting the people on the lowest income. So really we focus on those most in need. And then the way forward on the resources. So this is again prioritizing in a quite explicit way the locally owned and led businesses, which again is they will be reinvesting more their kind of profits, and they will also care more, what they're doing in a kind of more long term, rather than when it's just basically a market, right? It's their home, and when you operate in your home, you act differently. Defining also clearly most in needs. So there's sort of misunderstanding of vagueness often, what we mean. Definitely looking at kind of how we can support more informal economy actors and enhancing the investment as well in micro and small enterprises. I also would say that there's something maybe important to think about is the if the PDBs, because they are ultimately making some profits, that there will be some share of those profits actually going to support local CSOs to strengthen accountability and the social infrastructure. I think there's something about giving back to the same, that the country where the PDB is operating. I think there's something about that as well, like a social tax. And definitely, I think the cost of capital. I know this is a broader thing, but PDBs as well can probably play a greater role here to try and reduce these rates, because they are really really high. I can't think of having them in the Europe, for example. I think there would be a revolution. Yes, and I think it's also about really strengthening that alignment of the finance with the SDGs, climate action, and all that. So it's not optional, but we have to have the kind of really very clear strings attached to this finance, so that when we invest in whichever business is small or big, that they are addressing specific social, economic, climate agenda needs. And I had this very last, slide, which was focusing a little bit more on agriculture. Sorry, I'm taking a bit more time than you planned, but yeah, I'll just. So it really is that kind of issue, right, about the balancing the local food insecurity with food production for exports. I think it's a real big challenge. How we kind of those trade-offs and what we are seeing and what's the kind of theory change here. Also agricultural practice, industrial versus regenerative, and I think we'll have some farmers talking after me. So looking as well, how we can also support more kind of agroecological regenerative business, agriculture practice there. And then also, I think there's also the question about the trade and kind of export-led growth, reducing poverty, and mixed evidence around that. So I think it's also we need kind of, I think, a more like a stronger evidence when we make these kind of choices, and why we are making these choices. And as with civil society, I'm also suggesting that they're engaging farmers as well more directly in decision making. Yes, that's it. That's me. And yeah, if anyone wants to, talk to me about any of this, or I can be helpful, then yeah, happy to reach out to me. And I'm sure I can also share the slides as well. I'm happy to. Thank you.
Thank you so much, and apologize for being the time police. But thank you very much, Sandra, for providing these important insights into the main findings of your report. And as you mentioned, people can also write down your email to ask you question directly. Now I will turn over to Mr. François-Xavier Mbabazi, who is the Chief Executive Officer of the Ingabo Farmers Association from Rwanda. And he will take us through to better understand the practical barriers and specific needs of the farmers, the MSMEs, and the cooperatives. So over to you, François-Xavier.
Okay, thank you very much, Dianaïs, and thank you very much also for Sandra for her good presentation. I tried to, as you say, to talk about practical barriers faced by farmers, MSMEs, and cooperatives, especially their specific needs, by using our concrete experience here from Ingabo. Let me share my screen. You see my screen?
No, not
we
yet.
don't.
Okay, now I think it's coming.
Okay, thank you very much. So I'm saying that I will try to use my retail experience from here in Ingabo, at Ingabo.
Can you just put it? Sorry, can you just put it in full screen, please?
Let's try.
It's the last little icon on the bottom right of your screen. Yes, this one.
Like this?
Yes, perfect. Thank you so much.
Okay, thank you. Yes, I'm saying that I will try to use our experience here as Ingabo, which consists in facilitating smallholder farmers access to finance through a product that have been developed by Ingabo together with another microfinance institution, which is called CPF. And the CPF stands for Cooperative for Progress and Finance. So this, my presentation will go through Ingabo overview. We try to explain the context, and we also talk about the Zamuka cassava product, which is the financial product that we have developed. We also talk about the collaboration model, the results, and we maybe see the farmer impact, a testimony from one farmer, and we also try to talk about which kind of resource we can share here, and some key message that we can bring back as a key takeaway. So Ingabo is an association of with an experience of more than 20 years of experience. It supports farmers, and its mission is to improve the technical capacities so that the farmers can become competitive players on the market. And the action of Ingabo focuses mainly on the entire value chain, which stays from the quality of seeds, capacity building through farmer field schools, and good agriculture practices, in market access, and also we conduct some programs in advocacy sector. Ingabo has more than 16,000 members, which are dominated by women. Women are 55%, with a very little representation of youth, which means 20%. All of these members, they are organized in cooperatives, and those cooperatives also, they are organized along 6 major crops, as you may see. And the governance of Ingabo is led by a board of directors, a general assembly, and the day-to-day activities are run by a secretariat. And Ingabo also is connected to the different networks, both nationally, regionally, and also globally. So the challenge that we face, I think it's not the case for only Rwanda. I think it may be the case for many different countries around the world, is that the agriculture contribute to 27% to the GDP of the country, but which is something very strange, is that less than 60% of the formal bank credit reaches the sector of agriculture. This is for us an imbalance because normally as the agriculture contribute enough to the GDP of the country, it should have more finance than other sectors. And we try to look out which kind of barriers are behind this situation. As you see on the screen, these are the main barriers that we have identified. The first one is the high climate and production risks. This, I think we share this barrier with different farmers from different countries. There's also a low financial literacy, especially from smallholder farmers. There is a weak collaboration between farmers and financial institutions. And also there's a poor access to improved seed and inputs. As you know, without quality seed and input, you can harvest a good production. Also, we have identified there's also a long distance from the financial institutions to the farmers. There's also limited agricultural insurance, especially here in Rwanda. For some crops, the coverage of agriculture insurance may even go to under 4-5% of coverage. And also we have identified that there is some credit products which are not adapted to agriculture cycles. This have been the result of a research conducted by Ingabo in the framework of FO4CP program. Those who come from IFAD may know this program, where Ingabo shared this the result of this research to a stakeholder dialogue, where financial institutions and other stakeholders were convened. And CPF INESA, the bank that I was saying, took the first and approached Ingabo to see how what they can do together, so they can try to start to face this challenge. So Ingabo and CPF could design a product which is called Zamka cassava product. It is a product which focuses only for the cassava value chain, where the interest rates have been reduced from 24% to 80%, and also which gives a grace period to the cassava farmers according to the production cycle. And this is also a financial product which is cooperative based, because it is at cooperative level where applications are collected, where credit officers meet farmers to analyze the applications. And also it's a product which covers the seed, fertilizer, production, and the market. How the partnership works, as you have maybe understand, the partnership includes CPF INESA on one side, Ingabo in the cooperative, and each side have its responsibilities, as you see. For example, CPF opens farmers' accounts, provide loans, provide financial literacy, and also ensure loan management, while Ingabo conduct mobilization, technical trainings, climate smart agriculture, capacity building, and also ensures awareness monitoring. And the cooperative organized farmers collect applications, also participate in aggregation of the production, and also the cooperative intervene in the repayment of the credit given by the bank. As the results, we have started in 2021, and currently, as you see, they're not the huge amounts, but as you see, there is a progress. There is a constant progress starting from 2021. Credit disbursement have been increased year by year. Now currently we have for this crop also only of cassava, have only disbursed at least 1 billion of Rwandese francs, which is equivalent to 745 thousand USD, which I think it is an amount which is not very huge, but which is very satisfactory for us. If you can increase this partnership, I think you can even go beyond this amount. So these figures tells us that farmers invest more confidently because they are supported by farmers' organization. And also there is a strong collaboration between banks and farmers. Also, we notice currently something like the competition between financial institutions have improved. For example, this one which is called CRECAM, which is also a financial institution which is working with Ingabo, has reduced also his interest rate from 24 to 18%, and also they have tried to remove the compulsory 10% savings as a requirement for all applications. And I can also say that the road conditions also has improved for farmers. Considering only the 2025 year, we can see figures of people who have received the credits, a total of 484 farmers and groups have been reached. And among these people, there are women, individual women, women groups, and male farmers. For only 2025, banks have disbursed at least 305 millions of Rwandese francs, and you can see the breakdown according to different categories of groups that have been rendered. And as key achievement for this program, especially considering the year of 2025, there's a strong inclusion of women farmers, and women group, which contribute to the development of gender responsive agriculture finance. And also there is an increase of farmers, especially farmer groups, which contribute to the improvement of collective access to the credit. You know, there are farmers, smallholder farmers, who must to use the collateral, the social collateral, so they can have access to the credit. Again, there's also an expansion of agriculture financing to both individual and organized farmer structures. You see, through this product, there's no segregation. Both farmers, grouped or individual, they can access to this product. Also, considering also this progression, you can say that there is a scalability of this program of Zamuka Cassava financial model. This is a testimony of one farmer. It is ready, which is called the Nyinamana Jacqueline. She says that before Zamuka Cassava plant, she used to be rented money and to pay back every month. While with Zamuka Cassava plant, cassava product, she will pay only after the season. And also she's saying that without Zamuka Cassava product, she will not be able to practice the ZIPIT technique, which is a technique that we use in cassava farming, and which can give the production going from 15 tons per hectare to 45 tons per hectare, which is good for the farmers. As key lessons that we maybe take from this experience, there is first of all the co-creation, the fact of working together with farmers organizations. They allow banks to respond better to the real needs of the farmers. Also, there is another reason, which is working with farmers organization. They can contribute to reduce the lending risk. And also the fact of bundling finance to technical services also can contribute to the it can contribute to the productivity, to the profitability of the project that have been financed by the bank. And also there's another reason, which is to adapt finance to agriculture cycles, like what we have done on cassava. But also there's another one, which is the partnership, which creates a win-win situation for both partners in the partnership. So as Kime said that we can take from here, I want to say that smallholder farmers are bankable when appropriate products are designed. So if you can design appropriate product which respond to the needs of the farmers, smallholder farmers, they can be bankable. Another one is that farmers organizations are trusted partners for public development banks. We have been capacitated by different projects, different programs, and we think that we can stand and be trusted by a public development bank, and we can see which kind of synergies and collaboration we can have so that we can allow farmers, especially the small farmers, to have access to funds. Another one is that agriculture finance works best when combined with technical support. It's to say that finance alone is not sufficient. It should be accompanied by technical support. And also, there is a dialogue between financial institutions and farmer, which leads to innovation. You know, innovations come from the challenge. When there is no dialogue, know which challenge farmers are facing. And another one is that the Zamuka model can be replicated to other crops in other countries. You have seen that the Zamuka cassava plant, it can be even replicated to other crops like rice, like beans, like maize, and it can even be replicated in other questions and observations. Thank you.
Thank you very much, François-Xavier Mbabadi. It was important to have the perspective from a farmers organization. I apologize for the participants. I know that we're going to be a bit over time, but please bear with us for our last panelist. So I welcome now Mr. Mankoba Matsibuko. He is the Manager Business Development Support at the Eswatini Development Finance Corporation, so FinCorp. And over to you, Mankoba Matsibuko.
François, maybe you can stop sharing.
Yes, I'm trying to stop. Yes. Thank you.
Thank you.
Mr. Mazibuku, we're listening to you.
Hello, everyone.
Hello.
Is my screen showing?
Yes, it's starting now. If you can just, now we can see it. If you
Okay.
can, yeah,
Okay.
perfect. Thank you.
Okay. Thank you. Good afternoon. Thank you very much for this platform. I'm from FinCorp in Eswatini. I'm representing Eswatini Development Finance Corporation, which is a DFI in Eswatini, which was established in 1995, founded by the King Mswati III in 1995 and started operating in 1996. It is a state-owned enterprise. 80% is government-owned, and 20% is owned by DBO Tagangwane, which is a sovereign world fund institution. FinCorp's mission is to empower Eswatini citizen through the provision of meaningful access to credit, job creation, and poverty alleviation. So these are our objectives. Mainly, it is more on access to finance for SMEs, poverty alleviation, and job creation, and also providing business development support services to finance clients. So thus far, we are 30 years this year since existence, and we have actually disbursed in excess of 10 billion emalangeni to the local SMEs. And as we speak, we have about 1.5 billion emalangeni in the hands of Emaswati SMEs And in terms of job creation, we have contributed about 15,100 consistent jobs. And in terms of GDP contribution, we contribute about 1.5 billion emalangeni. Then FinCorp has subsidiary companies in First Finance, company which deals with general purpose loans, consumer loans, and Fincho, which is more of a captive insurance company. Then we also have FinCorp now, which deals mainly on SME lending. So this is the structure of FinCorp. And then we have a suite of products that we provide at FinCorp, which include other financing, line of credit, asset lease, long-term contract financing, working capital loans, property development. We also do have a fund that is targeted to the youth, and we also participate in local credit guarantee schemes and also provide non-financial services, including business advisory, mentoring, and coaching. So this is FinCorp's portfolio. We currently stand at about 393 million. And this is the distribution. You will note that a huge chunk of the loan is more leaning to sugarcane farming. And I'll explain that later as I proceed. So this is the makeup. These are the kind of sectors that we currently are invested in as FinCorp. Then these are our development partners that we work with. We have millers, we have sugar, Eswatini Sugar Association, we have local funders, we have traditional local authorities, we have the Youth Enterprise Revolving Fund, whereby we provide financial intermediation. We have eWait, it's Eswatini Water and Agricultural Development Enterprise. Then we have FinClude, which is a guarantee scheme under the Center for Financial Inclusion. Then we have NAMBOARD, which is a marketing board for vegetables in Eswatini, and which regulates import and exports of vegetables in Eswatini. Then we also have a guarantee from the Central Bank of Eswatini targeted to small-scale enterprise firms locally, whereby they provide a guarantee of 95% to first-time borrowers and 85% to repeat or existing businesses. Then we also have local funders and external financiers. So how we work is that FinCorp borrows money from the market, and some of the funders will includes currently the African Development Bank, the European Investment Bank, and NOSAD. So, but then coming now to the subject of today, why are we so much invested in sugarcane? If you see the kind of stakeholders here, the millers, Eswatini Sugar Association, and eWait, one can say that in Eswatini, the sugarcane industry is one of the most established and well-structured industry. And as such, it becomes a fertile ground to crowd in banks and DFIs. So that's why FinCorp as well has a huge concentration on the sugarcane industry. So if I may just go into that, what normally happens, we have the eWait, which is the implementing agency of the government that is more focused in providing bulk water infrastructure supply in the rural areas. They build dams and they provide irrigation infrastructure, road infrastructure. Then they also mobilize now farmers in the rural areas to go into commercial farming. The land tenure in Eswatini is that we have your Eswatini national land, which is held in trust by the king, and you also have the title deed land. So in rural areas, what's happening is that a lot of farmers are now changing from subsistence farming to commercial irrigation farming, in particular sugarcane, because the market is readily available. There is support from the millers. The millers have what you call the outgrower department, which provides technical support to the small scale farmers, as well as Eswatini Sugar Association, which acts as a market outlet which exports the sugar to EU and SACU on behalf of the farmers. Then you also have the traditional local authorities, which are in our setting chiefs, who are the custodians of the land in the rural area, and who also act as people who receive grievances and provide solutions to any issues arising within the farmer companies. So then you also then have the local banks who provide debt finance. But then one must say that under the e-Wait program, in a point in time, the European Union invested about 70% towards infrastructure development of the farms that was channeled towards land preparation, irrigation, infrastructure. And then what was required of the small scale farmer was accessing 30% of debt from the banks and DFIs, which then made it a more viable proposal or plausible proposal to the local banks and DFIs. So that is the background. If I may proceed. So currently, FinCorp has financed about 92 small-scale farmers, which average about 40 hectares. They're on a national land and on 99-year lease and title deed. Normally, when we finance on national land, we do not require any collateral, but then we depend on the offtake agreement from the millers. Then we also have about 19, on average, 19 shareholders per farmer company. I've already explained that they actually renounce their land for purposes of commercial irrigation farming. And then the majority of these are small-scale sugarcane farmers that have been developed under the auspice of e-Wait, the Eswatini Water and Agriculture Development Enterprise. So in terms of eligibility, when we look at an application at FinCorp for a sugarcane project, we have two distinct loan products, the seasonal loan and the capital loan. With the seasonal loan, looking at procurement of inputs, and with the capital loan, looking at the actual establishment of the sugarcane project. Then we also look at the formation, legal formation, how they are organized. We do finance sole proprietors, companies, cooperatives, and we at this stage confirm the shareholders list. Then the land, I've already explained that. Then another key element that we look into is the requirement of a water permit to draw water from the river basins in the country. Then there is an issue of market. We normally require a sugar quota, which is sanctioned by Eswatini Sugar Association. Then we also look at the farm plan as part of our due diligence. Then also another critical component that we look into is the environmental and social compliance, and also to check whether that pharma company has undergone intensive training program to cover critical subject areas in corporate governance, business management, and financial management before we can even extend that funding. So within FinCorp, we also have a business development unit, which basically focuses on enhancing the business acumen of the promoters and ensuring that the businesses are run sustainably and profitably. And the end goal is to ensure that the loans that have been advanced are repaid on time as well. So we provide business coaching and mentoring, course correction. Sometimes you'll find that the project requires some sort of like loans restructuring or loan structuring. Then we deliver capacity programs and various trainings, provide advisory services, conduct research and sector analysis. And we also collaborate with other development partners to strengthen client performance. We have collaboration frameworks, and we support clients on E&S compliance issues. So the challenges, achievements and challenges and lessons learned thus far. What was through our contribution, we have seen a lot of SMEs graduating to the mainstream banking, which in a way also poses a challenge to FinCorp because they actually take the good clients, the banks, but then that's the job of the DFI. We also see improved quality of life, in particular in rural areas. We see visible proper housing. Before they had stick and man, now you can see brick and mortar when you drive around the project areas, and proper sanitation and improve local infrastructure. We now have tarred roads and bridges, and we also see shopping complex being built around these areas now. So it's becoming a hype of activity. And we're also seeing robust economic activity due to spin-off businesses along the sugarcane value chain. As FinCorp, we also finance the small scale farmers to buy trucks. Once you have trucks, then you'll have the spares shop, you'll have the fuel service stations in those project development areas. Okay, some of the challenges we are currently facing is the issue of the climate change impacts. Too much rain, sporadic rains, which affects the farmers, especially during harvest time, and there is that lack of adaptation and mitigation measures. We haven't yet found in Eswatini an insurance company that can provide an insurance product so affordable to take care of these issues. We are also seeing external factors affecting the sector. Falling sucrose price, we are seeing rising electricity costs. We import plus 80% of our electricity from South Africa, Eskom. We are seeing rising fertilizer prices, rising fuel, prices due to geopolitical tensions, which is actually then squeezing the margins of the farms that were financed. Then another achievement of note is that coordinated development between stakeholders has the potential of delivering high impact to the underserved populace. That is, if everyone knows what to do or delivers according to the set responsibilities. Then another achievement, we are seeing the creation of job opportunities among rural communities. But then the challenge is that the shareholders are also farm workers with no clear separation of roles, which normally leads to conflicts from time to time. With the ENS compliance, by the small scale farmers, this has actually made them able to subscribe under fair trade, which pays premium prices for their sucrose sales. And the premium they use to it's reinvested in the businesses to build proper offices, ablution facilities, and improving the farm infrastructure. Another achievement that we're
Could you
seeing
please conclude?
progress. Yeah, I'm concluding, thank you. Is the retained earnings has allowed farmers to diversify. They now own their own trucks, and we are seeing farmers now switching to alternative or green energy in solar PV energy. I thank you.
So thanks a lot, and thank you for all these examples. We are very lucky today to have AFC Kenya, DFC Belize, the Bank of Bahamas from BDP Bolivia, Bancoldex and Finagro from Colombia, LNDC Lesotho, Benedes Pius from Mike Malawi is here also. FinCorp, yes, of course. UDB, the bank from Salvador, Botswana, Land Bank are represented. If any of you would like to comment quickly before we close the event and to participate to the debate. I forgot Kojovi Lanyo from Togo.
Yes, Kojovi, if you want to intervene even, I can open your mic if you want to say some words.
So don't hesitate to raise your hand, or we can also give the floor to Sandra if you want to comment some of the previous intervention in connection to the findings of your study, and answer to some of the questions in the chat, Sandra.
Yes, I can come in, but yeah, maybe whilst the others maybe are thinking of some questions or comments. But yeah, thanks. The other presentations also were really insightful. Really great to hear more kind of how you're working with farmers, and I think that is that direction, right? That especially I think in the first one there was about involving farmers, co-creating kind of those instruments, what actually works for them. So I think that's really something I think probably we need to talk more already as a good practice, right? It's happening. It's not something theoretical, and I think I take that as a good kind of insight forward. Also in the chat, I think there was a question about the climate finance and public finance, which I tried to answer, but I think it's essentially, especially from the international DFIs and PDBs, often the money what they're using, it is also climate finance, right? And I think that particularly sometimes is concerning that that money still can be sometimes kind of invested in things which where you can't see kind of that perfect alignment. And I think there's definitely still room for improvement in terms of how we are establishing that alignment. And I think there was another question. Now I forgot what was the question, but I also answered in a chat, but that was Yes, obstacles, but I think other presentations, other two really kind of delved into that way more, but obstacles for smallholder farmers. And I think the example as well, like maybe that is the kind of I think where the national development banks are able to offer the lower rates. And I think that is that kind of learning, I think, for the international ones, maybe, though it also depends on the countries and there's a bigger, obviously, picture behind. But I think that affordability of the rates, right, of the finance instruments for farmers is very, very critical. But yeah, that's I think is from my side. But yeah, thank you so much for having me here.
Anaïs?
Yes, thank you very much. Just replying also to one of the comments, all the presentation and the recording of this webinar will be available on our website. And thank you all for staying over time. We really appreciate, and I hand it over to Wenjing, who will provide the concluding remarks.
Yes, thank you so much to all our speakers, Sandra, François from Ingabo, and Koba from FinCorp, and thank you to all the participants for staying with us until the end of this webinar. And also, I would also like to thank IFAD, FO for ACP, the Farmer Organization Program, for their support and for helping us connect with Ingabo to bring farmers' organizations' voices and practical field experience to discussion. So maybe to make it short, for Ingabo's and Eswatini's FinCorp's experience show that how farmer organizations, cooperatives, and financial institutions can work together to adapt credit to agriculture cycles and combine finance with technical support and reduce lending risks. So one key takeaway is the need for stronger and more continuous dialogue synergies among PDBs, DFIs, the locals like farmer organizations, and development partners. I guess this is not just about top down, but also bottom up. And due to time, we might not be able to address all the questions today, but we remain available by email, and we'll be happy to connect you with our speakers. And I will also like to invite you all to continue engaging with the agri-PDB platform and our events. So once again, thank you all, and we hope this session has provided useful reflections for you. And thank you so much. Take care and bye.
Thank you, everyone.
Thank you.
Goodbye.
Bye bye.